I don't think at this point in time it is wise for government to spend or what people will call the fiscal spending to restart the economy. We need to do that when the economy is fully reopened. Given that we have very little uh, ammunition, you need to conserve it and use it at the right time. So the only time that that can materialize is that when we're able to fully reopen the economy. Otherwise, uh, you're just like trying to push a car that hasn't been used over a year and the handbrake is up. No matter how much you push it, the car won't move. You need to stay relevant to your clients. So how do you pivot to the new normal? Okay? And we know that there are two types of clients. One that is eventually technologically challenged and those that are technologically gifted. So you need to be able to address both, especially in a country like the Philippines. And eventually the third is being able to repurpose people and repurpose assets. Those are the key important things for companies to do.
In line with that, no, I want to translate everything also to the Philippine markets. That from where we are right now, we've seen at the start of the year, no, we were relatively higher, then we dropped every time we saw closures in the economy, and then right now, as of this recording, we're back up at the 7,000 level. Everything you talked about the economy, all of the figures, how does it translate to the markets right now and us ending the year as well?
Let's talk about the slope of hope, meaning these are the positive things that the market is looking at this point. Number one, investors are looking at the regional markets. When they look at the regional markets, it's still going up. It's led by the US. So the optimism of further economic reopening in the Philippines is also fueling people that, okay, sectors such as properties, the malls, are going to reopen soon. We're in a very important quarter because it's Christmas. Diba? So people will eventually try to go out, especially now that children that are 12 to 17 can be vaccinated. This is actually very good in support of further reopening the economy. These things is really creating an expectation from investors that probably this time there's more sustainability in further reopening the economy. So this is eventually driving your market past the 7,000. That is creating your slope of hope. Now, let's talk about the wall of worry. The 7,000 to me is eventually a wall of worry mainly because there are concerns about inflation. So this is something that's there. The other things is that because of the present situation, there could be new variants that could threaten another lockdown. So far, those have taken a back seat. But the high inflation condition is there. But a more pressing matter is the risk of higher US interest rates. So those three are actually the three main reasons why there's a wall of worry. But right now, the investor sentiment is taking on more risk because the markets have ignored all of those worries at this point in time. And that has created some activity. We've passed the 7,000 level. We're now over 7,200. And, well, as of this recording, we're up week on week by 4.4%. We're now at levels of around January of 2021. So people at that time were very optimistic of further reopening the economy. So this is where we are. So there seems to be certainty of, the optimism of further reopening. No? We've already seen that we're now in alert level 3 starting October 16. And the other thing is the vaccination rates. Despite we're the lowest in the region, is slowly climbing. We're around 23% on a vaccination rate as compared to probably the likes of Malaysia that are over 70%.
Does it also translate that, given that there's more confidence? Because if you look at what has happened over the past months, every time we close down, it drops. Every time we reopen, it starts to slope up continually. Does that also translate that if we don't lock down, do a hard lockdown again and PCQ again, is it possible that, given the other risks that you mentioned as well, we may not see large drops anymore, similar to what happened the past few months?
Yes, that's why as I said, the key factor really is to shift away from our present pandemic strategy. We need to eventually take a more aggressive uh, strategy that is more proactive, meaning we need to eventually take a more preventive stance, and that will mean allowing the economy to further reopen. So because we're trying to boost confidence, and boosting confidence again is more preventive. If we tell everybody to drink vitamins, di ba? To boost your immune system, that gives you confidence that you are not gonna get sick. Now, that can be translated to LGUs giving vitamin supplements to people, no? Especially for those that are marginally affected. So those are the things that government can do. Now, there was actually a second, which is the government support. I don't think at this point in time uh, it is wise for government to spend or what people will call the fiscal spending to restart the economy. We need to do that when the economy is fully reopened. Given that we have very little uh, ammunition, you need to conserve it and use it at the right time. So the only time that that can materialize is that when we're able to fully reopen the economy. Otherwise, uh, you're just like trying to push a car that hasn't been used over a year and the handbrake is up. No matter how much you push it, the car won't move. So that is the situation that we have now. Our economic managers know if we fully reopen the economy, and this is something that's already tucked in the 2022 budget, around 300 billion will be used for infrastructure spending. That could further restart the economy. Because you will, of course, assume that we will have an election. So part of this election spending will also provide a tail end or a tailwind to push the economy forward. So along with this 300 billion can really help push the economy to move back to the former growth levels of at least 6%.
I wanna connect this also, that there, to people watching this, there's a lot of retailers who are watching this video, and given that we're at 7,200 already, comparing it to where we were the past few months, we're not as low anymore. And if you would put yourself in their shoes, a lot of even the stay-at-home stocks have done really well. The broadbands of the world, the telecommunications companies and the essential companies have done well. REITs have done well. And over the past few days and weeks, the laggards, the Jollibees back to 230, BDOs at 130. We've seen a lot of the conglomerates also start to push up. What should their approach to be? What should their approach be, given all of the factors that have that you've mentioned, the risks that have been you've mentioned as well, and we're not as cheap as where we were a few months back?
Okay, that's actually a very good question. There's two schools of thought. If you, as I said, there are two schools of thought that I mentioned. The first is the slope of hope, meaning there's further reopening of the economy, and I guess the optimism that this could be a lasting reopening. Okay. Now, if we tend to look at the wall of worry, which is higher inflation, uh, the taper that is expected, and the rising US interest rates in 6 to 12 months' time, those are there as valid concerns. Now, if you as an individual, it's not that I'm trying to, they have to make their decision. Because at this point in time, these lingering concerns, okay, will eventually trigger higher domestic interest rates. And earlier, you mentioned this, that what happens if there are higher interest rates driven by higher inflation? And higher interest rates are not good for equity markets. So investors can do two things. If they manage to buy near the lows of this year, closer to 6,000 or 6,500, and they may want to lighten up their positions. Those that eventually were clean, meaning they bought because they sold before, maybe you might just want to either keep it and wait for the long-term recovery. But for those that are again on the side of the wall of worry, meaning you feel that this rising inflation, the potentials of COVID-19 coming back with a new variant, then you have to ask yourself, are you willing to take profit now and wait till you see the market coming down? And I think part of this rally that appears to be exaggerated is by the rumor sell the fact. Meaning, people are expecting probably third quarter earnings are going to do well. Despite the recent lockdowns, people still, these companies are still able to make a good third quarter. So if that materializes, then we can challenge the 7.4. Now, if there will be disappointments and there are still concerns, then that will mean we will not sustain this rally. So I guess from an investor's perspective, it's really how to manage this risk. And the only way that you can protect yourself is either do a trailing stop. So if you're already making money, look at the point where you think that you're willing to capitalize on your gains. So to protect yourself, if you feel that the market has still some room to bring it to 7.4, and probably reassess from there on. But again, if we look at the fundamentals, it seems that the wall of worry has valid points compared to the slope of hope.
I just want to do a deep dive further. Given that you have been in the markets for a very long time, what's going in through your head every time there's volatility? Because what I've noticed, a lot of people who are trying to invest on their own, when volatility happens, that's when emotions would kick in, and it could allow them to decide and do actions that are in different directions. What's going on through your head, and what do you do in times of volatility?
Oh, well, basically, from my perspective, I don't normally worry during volatilities. What I do is again, just like what I shared, I always create a slope of hope and a wall of worry. So I try to look at what will drive markets to move up and what will drive markets to go down. But what is important when it comes to retail investors is really, even before going to make that investment, I've already secured my most important points. Something that I can control. I cannot control the environment. I cannot control what's going to happen externally, what fundamentals to choose. But I can only offer 4 points that I know I can control. My entry level. I also control at what price I will exit. and what price I will put as a stop loss. So even before I make a trade, I have already these things in mind. So that when volatility comes and you act based on your emotion, you already will have to execute your plan. You don't have to rethink because you already thought about this ahead of time. Because when volatility happens, this is one of my most important and I think well quoted talk on risk management. No? When in doubt, pull out. That's exactly how investors do it. When they fear the markets and they're no longer in control, they act irrationally by selling everything. They just want to get out. I mean, a more common adage is when you can't stand the heat, get out of the kitchen. You can avoid that type of trap if you already have a trade plan in mind. So you must have your entry level, your exit, and stop loss. So these are very important when it comes to working on your portfolio. So this is, I think, very important. So for me, when there's volatility, I try to look at the fundamentals that will further support what market conditions exists. Meaning, right now and in the past few weeks, I've always highlighted that the 7,000 was a wall of worry. In the last few, in this week, we've seen this level been broken, and it seems that we're holding at 7.2. So the key question is, can this still bring us to 7.4? Now, what fundamentals will bring us there? And the only thing one can think of course, is the earnings for the third quarter. Now, if you want to stretch it a bit and probably will this rally extend to the year end, then a good confirmation is the GDP numbers for the third quarter. Remember, the second quarter was an 11.8%. But on a quarter-on-quarter, we slowed down by 1.3%, which was reflective of the second lockdown in the early second quarter. So since we had a lockdown, most likely on a quarter-on-quarter, we would have also slowed down. So this is something that, will that slowdown be as severe as what we saw the previous years or the previous year? So this is something that could eventually reaffirm the market's optimism if the data would not be as bad.
Before I head to our last topic, I'm just so curious on this. You mentioned about cutting losses, and I know there's a lot of variance towards this, but I just want to know your opinion on cutting losses. So say someone draws a support level, how do you determine your cut loss? Is it the number of candles, the length of the candle, or a certain percentage below the support, or a certain monetary amount? As long as it goes below the support and it's already around this, I'll sell also everything. What's your approach to getting out of a position?
What I would normally suggest is first really looking at it based on my portfolio or on my stock. So the first thing I'd like to look at is what are the technical supports that would be triggered. Okay, but normally I would always use a 1:3 on a risk-reward ratio, meaning I'm willing to lose 1 peso, but I'm expecting to gain 3 pesos for that 1 peso loss. So that is always my risk-reward ratio. So I will try to look at that, how much of that 33% is the closest support from my entry price. You will have to do a little bit of looking at the charts to be able to see what is the closest to the 20 or 30%. To me, what is important is a close below that support level. That will be triggered.
Got it. So whatever percentage or amount it is, as long as it closes below that, sell right away. Do you wait for confirmation for another candle for the next day, or
No, I think to me, one of the things that I would always teach my class, whether in Ateneo or in the RFT, is that in the financial analysis course, is that the most important is the close, because the close of every day is a summary of the day, meaning this is the feeling of the market, meaning the market has spoken to me and said, today the value of the stock market is at 7.2, and if it falls below 7,000, that means the market isn't convinced. And this is what we saw last week. The stock market fell last week, but today it gained, meaning the confirmation they saw was we shortened the curfew 12 to 4. Second, they've also lowered the alert level from 4 to 3 in the NCR. So to them, this is a confirmation that, sentiment is improving. And this is the gauge that I've been looking at for the past days. Just at the same, there are other people that still look at the wall of worry. And the key factor there really is you have to look at the volumes. Are they really sustainable and picking up? Because this could also, be a bear trap. No? If you don't break 7.4, then definitely you'll have a sell-off. We cannot talk about sectors such as consumer, industry, without talking how are we going to rev up job creation. Okay? This pandemic taught us that, the BPO sector and eventually remittances eventually became very resilient to us.